Hey everybody, I'm back. Hope everybody's doing well. Let's try to figure out this market and make some money. So a lot has happened the past year, I guess, since I've been uploading regularly. A few banks have gone out of business. That's the latest news. And the market hasn't really rebounded much since the big fall. I guess the big drop was it like first quarter 2021? So it's been a year since that big decline. It still hasn't rebounded. But I'm still trying to figure out the market like you guys are. So if you guys have tips, I'm open to it. Because when I think I figured it out, then something happens and I'm like, I don't really know what's going on. But it's what now with the whole banking thing, I've been really kind of studying banks and defaults. And I went back, I looked at like the Great Depression, because that was the biggest bank run. I think like 900 banks defaulted, something like 30% of the banks out there. That was a big one. And then savings and loan crisis, late 80s, early 90s. That was another big banking disaster where like 20% of savings and loans went out of business. And there's a lot of parallels between that, read up on it, and what's going on right now. Because well, what happened with Silicon Valley is they like most banks, they bought like mortgage bonds and treasury bonds, U.S. government bonds that were going out like 10 years to maturity. So they had to hold these bonds pretty much 10 years or longer whenever they matured. And even though they were paying like 2-3% interest, maybe 4%, not high interest rates. So as long as you held the bond till maturity, you would get your money back with a little interest. It was pretty much guaranteed because it's a U.S. government bond. Now, the problem is with Silicon Valley, they had so much of these bonds on their balance sheet. So literally, I think it was like almost half their deposits. Like they had like something like 100 billion of deposits from people who put money to the bank. So half of that money, or maybe it was like 40%, they bought these bonds, which is not a problem normally. But when you have these long-term investments, like these 10-year bonds, these long-term bonds are funding short-term debt. Because when you give a bank money, that's debt to the bank. That's a liability. It's an asset to you because that's your money and you can take it out at any point. But to the bank, it's an asset. It's a liability on a balance sheet. So they were funding short-term liabilities, your deposits, with long-term debt. And when there's a bank run, like people take their money out, then Silicon was forced to sell these bonds at a discount. And they and that's kind of what led to everything. They sold the bonds at a discount. Hey, Chris. Yeah, thanks for coming back. I'm glad to be back. I missed the channel. And I'm glad I get to do these videos again. I was living a nightmare for the past few months, but I'm back. So has anybody been following the Silicon Valley default and the other defaults? I mean, I've been really reading up a lot on it, and it might be boring. I did a video, and I think the video is really good, even though, like most of my videos, it doesn't get many views. I think it's very thorough. And I watch videos of other people. They get like 1 million views. And I think they still don't say things they say are not correct always. Like, and they're not even that clear with their description. So I'm not sure why they get 1 million views, but yeah, I quit. it wasn't really working. I think after you run a business, it's hard to work for someone else. But but I definitely missed it. Like I miss like doing the videos and interaction with the people on the channel. It was a lot more fun than somebody yelling at you all the time. Um, because you know how it is when you work at a company, if you have to do it their way, even if your way is better or different, it's you have to do what they want. Or if you're married, you probably know what I mean too. Even if you want to do something the way you want to do it, it doesn't matter. Even if it's a wrong way, you have to do it the way your spouse wants you to do it. People have a lot of pride in themselves. So it's kind of, it seems like the writing is on the wall. There probably will be more bank defaults. I don't think it's going to be like it was in 08. There probably will be more, but how do you identify another Silicon Valley as a default? That's a thing. I don't really know. Like, I could have looked at Silicon Valley's balance sheet, and I guess I could have figured it out. But even if I shorted Silicon Valley, I could have been shorting it for like a year and lost like $50,000 trying to short it and not making any money because the stock keeps going up. You just don't know at what point it's going to crash. If it ever does crash, like some companies like Tesla, they were riding the wave for a decade, and people were shorting the stock, losing millions or some billions. Now it finally crashed, Tesla, because it should never been that high. Do you know if there are more banks that have so many long-term? That's what I want to do. That's what I really want to do. And I looked at Signature Bank because they also defaulted, and I looked at a First Republic Bank's balance sheet. They didn't default, but they're getting close, and they don't have as many long-term bonds out there. It's not so much how much you have in long-term bonds. Like JP Morgan has more long-term bonds than Silicon Valley by far, but JP Morgan has trillions in deposits. So it's the percentage of long-term bonds relative to the deposits. I mentioned that in the video. So I think if you're, I think Silicon Valley was, did anybody know? I did mention, I think I mentioned in the video, I think it was close to like 40%. But so when they sold these bonds, they had to sell them at a loss, even though the only reason they sold them at a loss was because interest rates rose so much. And when interest rates rise, fixed rate bond prices decline. It's just math. So they had to sell them at a loss. So they took a $2.5 billion loss on those bonds, or $2.2 billion. And then they mentioned they were going to have to sell stock to shore up their balance sheet. So they're going to have to dilute shareholders. So that's why there's a bank run, because they had to dilute shareholders, and that's why people got concerned. It was really a small group of people who got concerned, and they told, like, these guys who run hedge funds and other large tech companies, they told like friends and families and customers, take your money out of Silicon Valley Bank. So there was a bank run. So if somebody says like the reason Silicon Valley went out of business was because of a bank run, although that's true, it's kind of like saying the reason my company went out of business was a lack of money. Like the reason XYZ company went bankrupt, you could fill in any company, is because they ran out of money, which is true. Every company goes bankrupt because they run out of money. It's just how it is. But why did they run out of money? Why did a business run out of money? Did they make poor decisions in order to get to that point? So lots of banks, like I mentioned in the video, every bank could go out of business if there's a bank run, because banks don't keep that much cash at the bank. They keep like maybe, I think it's 10% of deposits. So when you only keep 10% of deposits at the bank, if 20% of your customers want their money out, you don't have enough cash to give them. So theoretically, every bank go bankrupt. But why did Silicon Valley go bankrupt? Well, because of these, they sold these bonds at a loss, and then they would have to issue stock. But there were other problems, because in order for a bank to, the way banks make money is, they take your deposits. Like when people put money into their savings and checking account, they take that money and they loan it to someone else. So they pay you 1%, and they then loan the money you gave them and loan it out to someone at 8, 9, 10%. So they make that's how they make money on the interest rate spreads. So say they charge on 8% on a loan, they pay you 1% on the money you put in. So their spread is 7%. So they make 7% on the money you put into the bank. So that's pretty much how banks make money. So another way a bank could go bankrupt is if they lend out money to people and lots of people don't pay their loans. They default on their loans, which happens quite a bit. But a bank's the job of people working at the bank is to pull up the credit of the person they're lending to make sure they're not going to default. And if there's a likely chance of them defaulting, that person's going to have to pay a much higher interest rate to compensate for that risk, or you just don't lend to that person at all. They're just too risky. So that's another thing we could look into, like the loans banks have out there. Are they going to default? But I don't really know how to, we don't have the information on the people they lend to or the business they lend to. Like, we don't have their credit score, their history. That's too much detail. That's not provided to us. We get more high level information. So we could look at the bonds, how much they are invested in long term held to maturity bonds. I could show you on their 10K, if they should still have it up, the 10K. Silicon Valley Bank 10K. So 10K gives you everything you need. So just go, I think item 8, it's always item 8, the financials. So go to the balance sheet. And then, so they have 212 billion. This is as of the end of 2022, 212 billion of assets, 195 billion of liabilities. So when you look at this as just a regular investor, it looks okay. They have more assets and liabilities. But if you look a little deeper, and of course, I probably wouldn't have known this until this bank blew up. So this is just more information for me to look at in the future. So most of that 210 billion is in investments. So they invest in, they have to keep cash. They have 13 billion of cash. They have to keep at least 10% of the deposits. Interest-bearing deposits, 92 billion. So 10% of that is 9 billion. So they have to keep at least 10% of their, I think, interest-bearing deposits. Or is it not? I think it's 10% of both, but it's a little more complicated, the formula. But so they have 14 billion cash, 26 billion of available for sale securities. That means these are securities they purchase that they can sell at any point. Like when you buy a stock, you could sell at any point you want. There's no restrictions. And this is the problem, the held to maturity securities. So the idea is these securities will be held to maturity, not sold before maturity. And if you do sell it before maturity, then you run a risk of paying a big penalty or losing money, which is what they did. So 91 billion which is more than half. It's like 60% of their total deposits were in these held to maturity bonds. And of these held to maturity bonds, of the 91 billion, 86 billion, pretty much all of it, right, was at mature after 10 years. So they'd have to wait 10 years to get their money back. But they couldn't wait because people came to the bank wanting their money out of their deposit accounts. So they had to sell these at a loss. And the reason they sold them at a loss is because the Fed kept raising interest rates. If the Fed wasn't raising interest rates, like they haven't raised interest rates for what, 15 years now? They been keeping it at zero for so long. They finally raised them, and they've been pretty aggressive raising interest rates. So the value of these bonds fell a lot. Like, why would you this $10 billion bond yielding 1.48%? No one's going to pay $10 billion for 1.5% interest, because you can just go to the Fed, which is the same bond, right? It's risk-free, and say, I'll buy a $10 billion bond for 4% interest, because the Fed is offering it 4%. So why would you ever buy it from them and only get 1.5%? So that's why they had to sell it for $8 billion, the bond, to compensate for this lower interest rate. Yeah. Do you know? Yeah, I mean, I think, how do they not see this coming? I think ignorance could play a part in it. Like, it is hard to predict the future. Who knew the Fed would raise rates? They kept them so low for so long. And also, when you're at a job, the people at work at companies are just employees. Even the CEO, I mean, CEO is a pretty powerful employee. They're usually the chairman of the board, but they are technically an employee of the company. So the board can fire anybody, the CEO or anybody. So anyways, the people who are making the decisions at all these companies are employees. When you're an employee at a company, you'll take more risks, because if it's a home run, you get a really big bonus, right? And if it's a dud, you may lose your job, or you're probably not going to even lose your job. So there's not really much. It's like working at a job. Like, there's no benefit for you to, if you went above and beyond, or if you did the bare minimum, it's like you get the same salary regardless, right? So there's really no, I don't think a lot of these people care as much, and they're willing to take more risks, because if it works out, they get a really nice bonus. But now that I showed you guys how to do this, maybe we can work together and try to identify any bank that has held to maturity assets above 50% of their deposits. So they have like 91 billion of held to maturity. So 86 billion is more than 10 years. So let's do that. More than 10 years held to maturity. And they have 170 billion of total deposits. So pretty much half their deposits mature. I mean, half those held to maturity securities mature in 10 years. So if that ratio is around 50%, that could be a big problem. But the thing is, I think it's a scale of the bank. It's just so big. This is the second biggest bank default. If this was a regular regional bank, this is a regional bank because it's in Silicon Valley. There's not a Silicon Valley bank in every state. It's just in this in the Bay Area where I live. But a lot of regional banks, like the regional bank of like Nashville, Tennessee, or the regional bank of Toledo, Ohio. There's a lot of regional banks, and they don't have 120 or 200 billion of assets on the balance sheet. They have like 2 billion or a billion. So if those guys default, it doesn't really affect that much. Sure, it's the FDIC does have to insure that, but it's not a big hit to the FDIC. I mean, this is a big deal. But does anybody want a DCF? I guess I could do those. If you donate at least $5, I'll do a DCF live. But anybody else here? Anybody want to chime in? And then Signature Bank was the third largest default ever. They defaulted the same week as Silicon Valley Bank, but I looked at their these numbers too, and they had maybe like 7%, I think it was, of their held to maturity securities. It was 7% of their deposits. So I was wondering, why did they default if it's only 7%? And from what I understand, it was they had so much exposure to the crypto market. That's why they defaulted. And then First Republic is on the verge of defaulting, and I did the same thing, and they only have 10%, I think, 10% held to maturity securities, 10% of the total deposits. So I was wondering, why did they default? Or not default, but why are they getting close to that point? The stock is down like 90% in 2 weeks. And the only thing I could find is that they have like their loans, like this company has 73 billion in loans. First Republic had more loans than deposits. So it's kind of like this company received $170 billion from people like me and you who go to this bank, who put money to the bank accounts, the checking and savings or CDs. So they received 170 billion. They loaned out 70 billion. First Republic loaned out, I think it was like 110% of what they received. So they loaned out more than they received. That's called leverage, right? Hey, Ben. So I did it. I quit, like I told you. I know Ben in real life. So I have 4 businesses that I hope I can grow. This is one of them, the YouTube channel. And then I started this other business with Ben, is that I do these classes with usually like middle school kids or sometimes 4th and 5th graders. I think the average age is it's like 8 to 14 years old. And I have like 6, 7, 8 kids. And I do like a 2-hour class. I do this twice a month. I've done classes, inflation 101, interest rates 101, stock market 101. I'm doing real estate in April 101. How to run a business 101. So that's kind of fun. The loan to value in terms of what? In terms of like for the business, the loan to value, because like I have the loan to value on my home. If the value of my home is $1 million and my loan is 500,000, meaning I owe the bank $500,000. My loan to value, my LTV is 50%. So the lower the better. The less your LTV is, the better. And when you see an LTV, like First Republic was probably like 105%. That's bad, because when you're so leveraged, if a few people don't pay on their loans, you lose money. So what are you talking about loan to value in terms of like these banks, or in terms of what? But let me know. Everybody wants to donate. It's funny. I was at a hedge fund for like 8 months. You would think I would be. I think not that I learned less, but I kind of stopped following the market working there. It's kind of a long story. You would think I would be more involved in the market, but I was less involved in the stock market. Hey, Calcium, no problem. Thanks for commenting. RKT, is that Rocket Mortgage? RKT? Rocket, yeah, that's Rocket Mortgage, like rock companies. It's hard. These are really hard. I always kind of felt uncomfortable doing videos on banks, because I was never that, because I think they're the most complicated. Banks, insurance companies, and these types of companies, finance companies, are really hard to understand when you look at their financials. Credit Suisse. I interned at Credit Suisse in the mid 90s. I interned, it was in the World Trade Center. I interned at Credit Suisse. I interned at First Boston in the mid 90s. And that's when, and I interned there for a couple of years while I was in college over the summer. And that's when they merged with Credit Suisse. So then they changed the name to Credit Suisse First Boston in the mid 90s when I was there. But anyways, see, Credit Suisse is a different situation. And let me know in the comments if you have more information on this stuff. But from what I understand with Credit Suisse is a lot of like, kind of like dirty and shady stuff going on. Like not so much like just running your business bad, like these US banks have done. It's kind of like these insider trading things going on, or these sexual harassment, like really like the kind of bad stuff. Like that's what I read mostly about First Boston, or Credit Suisse, what led to kind of their downfall. But I mean, this was like them and RBS like own Switzerland. Like these are like massive companies. I mean, I remember it was like, look at this. Like it was like $70 a share. I mean, it was always like a pretty strong stock. I mean, I guess the peak was 08. I mean, but now it's just like under $1. It's a penny stock, which is just crazy. Hey, Vassal, what's up? Yeah. That's the thing is when you think shady stuff goes on in the US, which it does, but like when you're outside the US, not only does shady stuff go on, but it's kind of like accepted by the governments of some other, like not accepted, but there's no like repercussions. Like this, like you hear an entire country is doing something fraudulent. Like in the US, if there was something bad going on, we would crack down on it, and there would be so many Karens yelling like, this person's cheating on their taxes. My neighbor, my neighbor doesn't mow their lawn. Like there'd be so many Karens and Kens out there. Like nothing can like go bad in the United States without like some interference. But in other countries, the criminality can be pretty extreme, and there's really not much that happens when they get caught. I'm talking about like the white collar crime stuff is more accepted. Um, but RKT balance sheet. Let's. I mean, I would need like a few hours. It's very confusing, these balance sheets. But hopefully, I learned a lot by reading up on these banks where I could understand it better. But it's so funny because like during the during the Great Recession, I was like trying to reevaluate my investment philosophy, and I was like, these tech companies are just not where it's at. Like I was so bullish on tech, especially Facebook, but like other tech companies, like I'm like, that's the future. Tech is the future. Like you can't get around it. Like it's changed the world for the better, some negatives. And then tech crashed and burned. And I'm like, maybe maybe it was just so overvalued. Let me stick to something safe. Let me stick to banks. Banks seem safe. I didn't invest in any banks though. Ironically, I didn't like actually go that far, but I was thinking like maybe I should just stick with banks. Banks are stable. Banks' job is to receive money, actual money, and make more money. So it seems like a smart investment. But now I'm starting to think maybe I should, like Warren Buffett kind of thinks closer to this. I want to start investing in things that people really need and want, not like these Kraft Heinz kind of company or these Johnson & Johnson company. Like people will always go and buy like ketchup or buy medicine like Tylenol, like things like you don't have to convince people, and that's been around for over 100 years. That will be around for over 100 years. Find a company that does it right and just stick with them. So maybe I don't know. And I thought about that too. Like just I was going to build up my Kraft Heinz investments. I remember at one point, but then I kind of like see these tech companies with these amazing returns and commodity super cycle. I don't know. That's another tough one. But commodities, I think, are why is it only 2021? Did they not do that 2022 financials? But especially with like EVs and you would think commodities, there's going to be continued demand, but I don't know. Things change so much. Just when you think you know it. Yeah, staples like a Starbucks or McDonald's. People just always go to them, and they're not as replaceable. Even though you think everybody thought like Yahoo wasn't replaceable. Like Yahoo was like everybody used Yahoo or AOL when it first came out. Like that's all anybody talked about. And then so tech kind of like things change too much. Although it's hard to imagine Google getting replaced, but I guess anybody could. So Rocket. Rocket Mortgage. But I do like commodities. I just don't. They don't have the upward potential. Like there's like you can have a commodity that could go up a lot, down a lot. I mean, after 20 years, it might not have moved much. Um, it's not like a. I think it's a good. It's. I think it's good for stability. If you want something kind of like stable in your portfolio or a hedge against the market, like gold. But I guess I don't understand it that much. I don't see the value there as an investment. But um, so, what do they do besides? Is it mainly if you need a mortgage on your home, you contact them and they provide, they connect you with a bank to get that loan, or do they do other services? I'm sure they do a lot more. Do they do like car loans and things like that? You'd be surprised how many people don't really understand how a company works, and they try to give you investment advice. But it's hard to really talk about their balance sheet or income statement without really understanding what they do, at least basically. The largest retail lender in the United States. It's the largest mortgage lender. So I guess that's their main business, right? Mortgages. Okay. I'm sure they have other side businesses, but they're mortgages, which is a pretty safe type of company to invest in, mortgages, because when you invest in like these like shipping companies or even auto manufacturers, there's so much volatility with prices, right? And there's so much competition. But with a company like this, it's kind of like it's almost guaranteed. It's like a service type business. They don't really have to invest in like infrastructure. They're not going to build an oil well. It's just taking people's money. And I don't even, they're probably not even a bank, Rocket. They probably just connect people with banks. So they probably don't take any risk. Um, are they in? Are they an actual bank? Do they actually give the money? I don't think so. $23 billion of assets. You know, I used to focus so much on the income statement, and now with Silicon Valley, I'm like, I think more about the balance sheet. Even though like the balance sheet is really the worth of your company. It's like your friend who makes $100,000 a year and drives a nice car, or even $200,000 a year, drives a nice car, lives in a nice house, and you think they're all set, and they have like they're upside down on their mortgage, they have no cash in the bank, because that's their balance sheet, their net worth. Their balance sheet is like what they're worth, not what you see, not the nice car, the nice home, the trophy wife. But your other friend who has what seems like a dead end job, making $60,000, and they drive a beat up car, and you look at their balance sheet, they have like 250,000 in the bank. They paid off their home. According to their net worth is like $1 million. Their balance sheet. So that's the value of the company, the balance sheet. The flashy stuff is the income statement. But anyways, so mortgage loans held for sale, 9 billion. Funding facilities. So they have total assets of 23 billion. I guess they provided $9 billion of loans to people, or businesses maybe. And I guess the servicing rights, because I guess they service these loans too, that's worth 7.3 billion MSRs. I don't really understand. That's worth 7.3 billion. Okay, it is just a servicing part. Mortgage servicing rights refer to a contractual agreement in which the right to service an existing mortgage is sold by the original mortgage lender to another party that specializes. Okay. So the servicing, the value of these service contracts is $7 billion. So if they do sell off the loans, they can sell not only the value of the assets, but the servicing rights too. Because companies like this make a lot of money because they have to make sure the person's paying. So every month, that person has to send in their check or wire in their mortgage payment to Rocket or one of Rocket's bank accounts. And if the person doesn't send in their mortgage payment, Rocket has to contact them. And after like 3 or 6 months, then Rocket has to start the foreclosure process. So all those fees, the value of those fees they collect is worth 7.3 billion. So they didn't actually collect that money. They're going to sometime in the future. That's the value of those service rights. Loan subject to repurchase right from Ginnie Mae. Ginnie Mae is one of those quasi-government organizations. So if a company can't get a loan from like usually they go to like it's Fannie Mae, Freddie Mac, or Ginnie Mae, and that's like they get a loan through them. It's a guaranteed rate, or it's not guaranteed rate. It's a particular parameter of person can get it. And if you fall outside those parameters, like for instance, if you need a loan above like $500,000, a jumbo loan, or if you have really bad credit, you can't get a loan from one of these quasi-government organizations. You have to go to like a bank, like JP Morgan. So the value of these loans and the service fees is 16 billion. See, it always looks good when you look at it, just like Silicon Valley. Like it's so hard to tell because, like, just for example, if they lent money to people who can afford the home, like that had good credit, that put down like a 20% down payment or even more, 30, 40%, then I'd say they're in really, really good shape. But if they lent money to people who had weak credit, maybe moderate or weak credit, and didn't put down much when they bought the home, 10%, then they're in bad shape. But we don't know this. I guess there's maybe a place they talk about, like they probably put in buckets, like how much was lended to one, like of the 9 billion, like 7 billion was lent to people with credit scores above like 650 or 700. I guess that's how you would find out if it's. But besides that, like I mean, how would you really know if the company's in bad shape? Like it's really hard to know. It's not as obvious as Silicon Valley was. Of course, most people didn't know to look at held to maturity um, as a percent of total deposits. But hey, Jen, what's up? Let's see their income statement. It's so confusing, their income statement. Like, you don't really get a good picture of a company or a finance company. Look at their income statement, because gain on sale of loans, excluding the servicing rights, 140 million. 2021, this is just for one quarter, it was 1.7 billion. So that doesn't seem good, but like, I don't know. It's if anybody knows, like, I'd have to like learn about this a little more myself and compare it to other companies maybe who do the same thing and see if this is a common trend where the gain on sale of loans decreased so much. Servicing fee income, that's gone up a bit. That's good. Change in the fair value of servicing rates. They did have a negative in 2021. But it's not like they lost money servicing people's homes. It's just the fair value adjustment. The same thing with Silicon Valley. They didn't lose any money on those on those assets they sold if they didn't sell them, right? You don't lose money on a stock until you sell. Not going to lose any money as long as you hold it till maturity. You'll get your principal back plus a little interest. But if you have to sell it in between, when interest rates go up a ton or down a ton, that's when you may not make as much as you thought. Plus penalties too. It's like if you take a mortgage out, and it's mostly for commercial mortgages. If you take a commercial loan to build, say you wanted to build a strip mall, you take a $10 million loan with like 6% interest. There could be a prepayment penalty if you pay it off within the first 3 years. You have to pay like a $200,000 penalty. But some people still pay it off because the penalty, the amount of interest they're going to pay for the next however many years is going to be so much. Especially if you get locked into like a high interest rate, like say interest rates are like 9%, and then you take this loan out and you're paying 9% interest every single month on like a $10 million loan, and then rates are down to 2%. So you could chop off 7%. So it may be worth paying that penalty. If anybody refinanced their home, they know what I mean. Sometimes it's better off to pay the bank. Usually it's not a penalty, but you have to pay like broker, like refinance fees, like maybe $10,000. I think that was in New York. I don't know if they have that in California. Yeah, that was a New York thing. If you live in New York, I don't know what other states, but we paid like pretty high fees to refinance. But then you have to look at how much you're saving in interest to see if it makes sense to pay those fees. And we refinanced in California, and there was almost no fees, very little. So it was like, of course, you would refinance if you're getting a lower rate. Yeah, I don't know. I mean, I don't know. I don't understand earnings for companies like this. They're not indicative of how the company's doing, because there's so many like uh, mark to market, like these fair value adjustments. Um, so you have to look a little deeper, and it is a bit confusing. But when you look at it side by side, it does look much worse. Um, 55 cents EPS down to 6 cents. Why did it why did it get so much worse? Yeah. Well, Jin, yeah, Silicon Valley, that's what they wanted to do. They wanted to borrow. Oh, well, not borrow, but they wanted to issue stock, because they had to sell some of those assets they bought. They bought those bonds as an investment, and they had to sell it because people wanted their money out of the bank, so they had to sell 2.5. I think it was like 2.5 billion of those bonds. They took a loss, and then they wanted to sell stock, so dilute shareholders, sell like $2.5 billion of stock, and that's when things got really bad. But are you saying why couldn't they just take on debt instead of selling those assets? That's a good question. I mean, I guess they could have, but sometimes you make a decision thinking it's the right one. Like, should we, like, if you and your spouse needed $50,000 for a new roof and a new car, should we just take a loan from the bank, take on debt, or should we just sell something in the house? Maybe you could sell our old car, or if you have a summer home, sell an asset. So sometimes you make the wrong decision. Sometimes you sell something. Say you have a second home that you paid $100,000 for, and it's kind of a not too expensive place to live, so never really went up too much in value. So you sold it for like 75,000, even though it was worth 100 because you needed the money quickly. And then 3 years later, tons of people moved to that town, and the value of those homes is $200,000. So you should have just took on debt. I don't know. It's some people, some even businesses just make the wrong decision. So I'm not sure. Maybe it wasn't an option. Maybe they just couldn't take on debt. Maybe they were at that limit, based on other things. I don't know. But yeah, it's definitely something to consider. But generally, what I always learned for these types of companies, like mortgage companies or banks, insurance companies, you look at the price to book ratio. Um, you look at the book value, which is the equity and about the equity, and it's 8.9 billion. And you compare that to the market value, the market cap, and if that is getting better or worse over time. But like I said, with Silicon Valley, a lot of other things, there's more beneath the surface than just that. But that's kind of like the real basic way to do it. And I've been doing arbitrage, retail and online arbitrage. So I've been buying and selling things online. I'm selling it on like eBay and Amazon, and then or I buy it in stores. Yesterday I bought a CD from Goodwill for $2, and I sold it for $20 on eBay. So I'm just learning the process, but just something to do. I have a lot of free time, so Yeah, but what's everybody's thoughts on like the government backing 100% of Silicon Valley's loans? I mean, assets or deposits. Because usually the FDIC insures up to $250,000. So if you had a $500,000 in a savings account at Silicon Valley, in a normal situation, you would only get $250,000 back, and you would lose $250,000. But I think for the first time, the FDIC is backing everything, so you would get your entire $500,000. And 90% of the money at Silicon Valley was uninsured. So 90% of the money was above the $250,000 limit. So what was it before? We were just looking at it. It was like 140 billion of deposits. So they're backing everything. Yeah, no, I've been doing books. I actually posted a lot of books yesterday. Somebody showed me how they do books. So I bought like 20 books, maybe more. They were all $2 each. So I'm just kind of learning the ins and outs. I don't know if I'll ever make much money from it, but it's just something to do. And then I have a business, like a brick and mortar business my wife runs, and we just franchised that. So we're going through the franchise process. And I was kind of proud of myself because I've opened other businesses before, but I always use LegalZoom to create the LLC and get the tax ID. But I did that all myself, and it was free. Like, why spend a few $100s through LegalZoom? So I created the LLC. I went to the California Secretary of State website. And that might have been $20. No, it was free. It was free to do that, to create an LLC. Then I went to the IRS website to get a EIN number or tax ID, so I could file taxes with the new entity. Right. The Fed doesn't want to collapse, so they backed 100%. But wouldn't you be pissed if, say you had $500,000 at a bank like 2 years ago, 3 years ago, and the bank defaulted because the bank made bad loans and people weren't paying back the loans and they ran out of money. And then the FDIC came in and took over the bank, and you lost half your money. You had $500,000 and the FDIC only insures up to $250,000. And now you find out all these like really big like tech companies, because that's why there's so much was uninsured, because a lot of companies had like millions and like tens of millions of dollars in accounts at Silicon Valley. So those tech companies don't lose anything. They get 100% of their money back. I'd be annoyed. So it's kind of like sets a precedent. Like if another bank defaults, I guess they're just going to back 100% of deposits, because people will be pissed if, like, why did you back this bank's deposits and you're not going to back, our bank, our little bank with only 10 million of deposits. Yeah, they're definitely scared of more bank runs. And yeah, that's why they did it. I understand why they did it. But it's kind of, but do they have the money to do that? I guess it's just going to be more, the bank's going to have to charge more fees to compensate for these high fees. Like during the Great Depression, when the FDIC was created, FDR created it. Banks were really upset because they didn't want to pay all these fees to the government. Which makes sense, because if you had a business And then just one day, the government says, you're going to have to give us 2% of your revenue, your top line revenue, every single month as an insurance policy for whatever reason. You'd be pissed. Even if it's helping the greater good of everything, these banks, there was a lot back then. Now there's not as many, but these banks who screwed up, who made these bad decisions, bought too many long-term bonds or lended money out to risky businesses. Now I have to pay more money in fees because of these few banks. That's not fair. And then as a bank, or regional or a small bank, then you feel, why don't I just take risks? Because there's nothing that could go wrong. If it works out, if it's like investing in a penny stock. If it works out, you 20x your money. If it doesn't work out, you got your money back by the government. Like, why wouldn't you just always take that risk? Like, there's really no reason not to. Why play it safe if you're guaranteed to have like a backstop, like your parents? It's kind of like if you have rich parents and you start a business, and you after 2 years, if the business folds, then your parents just give you another $100,000. It's like, you could take risks. It's much easier to be successful in life when you have a backstop, when there's no like repercussions. What do you think about the current valuation of the banks as a sector? Yeah, that's a thing. I think, like banks like JP Morgan, have they gone down a lot? Yeah, you might get a nice discount because there are really good banks out there. So they were up to 170 at the peak. They did fall to 100, and this was at the end of 2022. That's when and it was the beginning of 2022 when things started crashing. So yeah, I think you definitely get a good deal, because these huge banks, they really can't fail. I mean, even if they try, they can't fail. Like, they were all, the government bailed them all out, except Lehman Brothers. They let them fail. So they really can't fail. But I don't know. It's just yeah, Peter Schiff. I like Peter Schiff. That's a nice thing about the government, is they could just keep printing money. You don't have that ability when you're a small business. You can't just print more money. But it's hard to figure out, because which are the banks that are going to be the ones? Because look at these. Like, it was for a long time, it was, the market wasn't moving too much for a long time. And then after the dot-com crash, there was a huge run up. No, this is not up to the dot-com crash. There was a huge run up, and then Actually, .com is here, and it was in 2000, right? Oh no, right here. Here it is. Okay, this is the .com crash. Well, there was a big dip in the late 90s. Why was there? I was in college. I don't even know why there was this big drop, but there was a huge run up, and that was the peak in 2000. I worked at JP Morgan right here for 4.5 years. And then the .com crash, and then it brought it down to almost where it was in the 80s. Oh. This is probably during the savings and loan crisis. That was the late 80s, early 90s. And then there was a nice run up, and then the Great Recession, 08, 09, during the subprime crisis. So it brought it right back down to those levels again. So if you wait long enough, it's going to probably come back down. And then the biggest bull run ever for over a decade. And this is COVID right here, COVID. So COVID didn't bring it down that much like it did in the past. So yeah, your guess is as good as mine. In the late 90s, 1,000 small banks went bankrupt. Oh, that's interesting. I didn't know that. In the late 90s. Why? Was that like a... Do you know the reason? I know the late 80s, early 90s one. Was it the Japanese banking crisis of the 90s? The savings and loan crisis of the 80s and 90s was a failure of 32%. Yeah, I remember that, reading about that. But I wasn't familiar with the late 90s one. So history repeats itself. It's always I want to do a really long video on the history of banking, but I know hardly anybody watches those things. The evolution of banking over time. Was that when they had to pull in Buffett? Yeah, that was the Great Recession, when Buffett helped Goldman Sachs stay alive. I think that's what you mean, Jen. Didn't it start in Italy? So that's a country that's a lot of shady things that like a lot of people do there. And it's justifiable shadiness. It's not like murder or like something really bad, like beating people up, robbing them. That's bad stuff. Nobody wants that. But when you steal from the government or cheat on your taxes, it's kind of justifiable. People are like, okay, that's not so bad. If you steal from a big company, it's okay. Just don't hurt someone. I mean, it's interesting, and when I talk about stuff from the past, people are like, I don't care about the past. Just tell me if a stock will go up or not. but you really knowing about the past can help you with stuff like that. No, I'm not worried because Warren Buffett, I don't think is making any major decisions anymore. I think he's involved, and I think most of the decisions are by the people he hired to run it. I think as a figurehead, people pay a premium because of his name. It's kind of like Air Jordans. Of course, they, I'm sure they were good sneakers, but like I bought Air Jordans because I love Jordan. I was in high school or middle school, and everybody loved Jordan. I mean, you would just want to be cool. You want to associate yourself. So it's kind of like that. Uh, just that name. It's you pay more, but I think there may be a drop because the name will, I guess, go away when he dies. But then when people realize it's the same company, yeah, I don't think it's kind of like when Bezos left Amazon or what's his name, Elon left Tesla. The companies are run well, so I don't know what the late '90s why 1,000 banks. Uh, it's usually the same answer every time, right? Leverage. If you want to, why did this company go bankrupt? Why did these banks fail? It's usually leverage. Just levering up too much. The act closes a chapter on a savings and loan crisis by providing the capitalization of savings and loan insurance fund. This act accomplishes the following. Oh, was it the Asian financial crisis that led to banks failing in the U.S.? Was the wait? When was the war in Middle East? No, that was mid '90s, right? When George, the older George Bush, the Iraq War, but that I think that was the mid '90s, right? Because that could lead to a lot of turmoil. I don't know. Well, hopefully I could grow the channel again. I've actually been for a few months now. I've been declining. My subs have been decreasing each day. It was like 1 or 2 subs a day. Now, first it was like I was losing on average of 1 sub a week. Then it was like 1 a day. Now I'm up to like 3 a day. I'm losing. But see, subs the past 30 days, negative 34. That's only because yesterday I had a positive. But for a few months, I was negative most days, losing 1, 2, 3, 4 subs. Yeah, 91. I thought I was in high school in 90. Yeah, 91 it happened. The Iraq War. So It's hard to tell on this chart, but yeah, so I had more subs last year than I do currently, but now it'll go back now, I think, because I lost a few hundred the past 6 months. But once I start making videos, I'll be adding a few each time, and that'll kind of like absorb the one or two that leaves. But I guess no one likes these other types of videos. I heard you can crush a golf ball with 2 fingers. No, I don't know. Never heard that. I crush a golf ball. I mean, I did hit a golf ball. I could hit a golf ball almost 300 yards if I keep hitting it and at the driving range. I can't do it consistently or straight, but yeah. So these videos never really got much traction. This insurance stocks was my best one, 1,400, but a lot of these never even broke 1,000. SEC filings 300. Because the place I worked at, they said I can't do videos about specific companies. But okay, I guess I'm gonna get off. So thanks for joining, and I'll try to do I guess a live stream maybe every Saturday. That's when I used to do it, on Saturdays. I got to figure out, but I should be doing videos every day, DCFs. I was thinking of doing 2 a day till I got caught up because I'm behind on so many. Okay. Well, I'll talk to you guys soon. Thanks for joining.